company goes through periods of fundraising where you're almost like selling the business right to investors or courting VCs. But then once you enter the partnership, once you've got investors around the table, the dynamic should very much change, right? The pitch is important is because we want to understand how founders are selling their company essentially, right? And so if I'm sitting there, if you can't sell to an investor, then are you going to be able to sell to a customer? Founder to founder relationships are one of the number one reasons why down the road companies run into issues, to your point. And it's not just, how did you meet your co-founder? It is, have you sat down and had some of those difficult, pointed conversations with your co-founders? Getting into that personal, because when you go into starting a business, it becomes personal. It is your life. But when you're starting a company and you're going into business with somebody else, I think it's very important to have some of those deeper personal conversations so that you really understand where the other person is coming from, what their constraints may be, how they approach working, right? Working styles, I think, is very, very important too.
It's a great position to be in. You have built your product, you got users, you got some revenue as well. So now you are pitching to raise some capital. But VCs, they nod, they smile, and you're getting a very polite thank you. We'll be in touch. And you're left wondering, was it a pitch? Was it the product? Was it me? Something else? Well, here's the thing. Majority of founders pitch their startup like it's a product demo. But VCs aren't buying a product. They're buying success pattern. And if your pitch doesn't match what they have learned to trust, you ain't getting the check. Hey, what's going on, everyone? I'm Mike Sirius, and this is Mastering Tech Growth. Every week, we sit down with industry leaders to bring you no-fluff tips on how to grow. If you enjoyed the show, please do me a favor. Hit that subscribe button and send me your biggest growth questions at masteringtechgrowth.com. I'd love to know what you're working on and what keeps you up at night. Joining me today is Alexandra Nicoletti. She's a partner at Camber Creek, one of the leading VC firms at the intersection of tech and real estate. Before this, she was in real estate private equity at Apollo and worked in investment banking at Goldman Sachs. Alexandra has seen every version of a pitch you can imagine, and today she's breaking down exactly what separates startups that get funded from the ones that don't. Welcome to the show, Alexandra.
Mike, great to be here.
Thank you for finding time for us. I know you are a very busy person. It was very hard to get through you via email, so I really appreciate you finding that time for us. We'd love to kick off the show with this question. When I say mastering tech growth, what comes to mind?
I love this starting question, and I think you ask it to most of your guests. To me, I think mastering is an interesting word, right? Off the cuff, I think about perfecting something, but I actually think in the VC venture backed and tech world, to me, it's more about optimizing rather than perfecting, because in the startup world, everything is a trade-off. Right. I think almost every decision there comes a trade-off, and particularly in the early stages. And so when I think about mastering tech growth and what that means, to me, it means how do I continuously optimize my growth of the business at every turning point, and with new information inevitably, and we can, we should get into this more, but inevitably that optimization can change and should change. There's a sort of a natural evolution there.
I love how you put that. It's very strategic way of thinking about things. Everything is a trade-off, 100%. You're never getting where you want. You're going to be leaving something on the table in exchange for something which makes sense more at this particular moment when you're making that decision. And when you say optimizing, Alexandra, what is in your mind when you say optimizing? Is it like process optimization for efficiency or something else?
Well, yes, I definitely think, there is process optimization, but to me, it's even more high level than that, right? Depending on the product, the market that you are in, and the stage of the business, right? How do I optimize for for sort of that next phase or that next, where I'm trying to go from,
Yep.
whether it's 0 to 1 or 1 to 2. And oftentimes that means, not growth at all costs, right? Which I think, we've seen companies, certainly seen companies fall prey to that. And often that means, maybe prioritizing other things, whether it's really landing, that first customer, or executing well with that first customer, developing a relationship with them. It can mean any number of things at any given point in time, but
Okay.
what's going to set you up for success best. And to your point, right, because you've got limited resources, right, that it is a trade-off, but making sure you're sort of optimizing the resources that you have.
I love that. That's excellent. You mentioned growth at all cost. And what came to mind is all of these startups just effectively not failing, but being put in a very tough position because they over leveraged debt and took some money in it, and of course spent all of it, just got a lot of headcount and just aggressively went in the market. And now interest rates changed and everyone is finding themselves in a quite tough situations. From your perspective, as a person and as a, investment expert, let's say like this, when you see startups going very aggressively towards growth and going after the market, is that a good thing, or is that like a not calculated risk?
To me, it's typically, and I like the way you put that, not calculated risk. To me, it is typically not calculated risk. Look, I think every situation is different, right? But growth at all costs is never something that we are prioritizing. I was at Camber Creek and as a venture investor myself. So I think 2020, 2021, to your point, was a really interesting time in the market where VCs and capital were okay funding businesses with that mentality. And we've seen the reckoning. We've seen that dial back over the last handful of years. And so, I think founders are understanding that the capital won't be there if that is your approach, and I think that's the biggest thing, right? If we're talking about what VCs are looking for, right? It's smart growth. It's not this growth at all costs. I'm gonna burn through all of my capital and just expect that more capital will be there at the end of the day, because that I think that is definitely a pitfall, and goes into, as the way we think about businesses is, even at the early stage, are you a capital efficient business, and does the founding team have that sort of capital efficient mentality?
I love that. I mean, otherwise it's a gamble, isn't it? It's almost like I'm all in. Like I over leverage myself. I'm literally at the line. I'm just all in. I'm either going to be huge, get all the pot, or I'm going to be burning. So there's no like, it's very binary in a sense. Like, but what we're saying is that we do want to look at the capital efficiency, how it's going to get spent, and be a lot more risk calculated when it comes to how we're spending money. Is that Yep.
Yeah, I mean, us at Camber Creek, we don't take bets. To your point, we don't gamble with our investors' money. We take calculated risks. We do our work up front, and investing in that growth at all costs type of company would, to your point, would 100% be a gamble.
Yeah. Okay. So we went a little bit into these like good signals or green lights, let's call it like this. So I have this quote from Harvard Business Review, which effectively says that investors rely heavily on pattern recognition to make fast, high-stake decisions under uncertainty, seeking trades that match past successful ventures. So Alexandra, when you sitting across a founder at Camber Creek, what are the patterns you're subconsciously scanning for?
It's a great question. I think there is a little bit of a misnomer with a lot of founders that, they think VCs are chasing the hype or whatever the latest trend is. And we could talk about what those are today, right? Versus, a couple of years ago, and what they might be, in a couple of years from today. I think the core of it, though, right, is, that's not the pattern that we're looking for. That's not the trend that we're looking for. Really, at the end of the day, what we're chasing, patterns in the founding teams and what we see from them, right? We're investing in founding teams, and so it's, a lot of it is, on founding teams, is focus, discipline, customer obsession. I think is a really important one and an interesting one, and it's almost more about, at the end of the day, we're investing in the people, less so the product or some other trendy or flashy name.
Mm-hmm. I actually have this question somewhere down the line in showing in my back on my head, because I remember a quote, and someone said it, that the VCs will invest into B plus idea with the A plus founding team versus A plus idea but the B plus founding team, which effectively means the idea could be weaker, but if the founding team is quite strong, that will be a better investment than a good idea but quite weakish team. Is that correct? Like, that's the reality?
100%. Obviously, if we're picking things out of a hat, we want A plus all around. But the founding team, especially at the early stages, right, that's significantly more important. And a lot of what we look for is ability to execute. Mike, to your point, ability to execute is a huge one. And the second sort of trait I would, or maybe two, if I'm picking, one, I think, is humility and ability to right, not just be solely tunnel focused on execution, but ability to stop, pull back for a second, and listen to your people around the table, your personal advisory board, so to speak, and take some of that input, right? And so when we're investing at Camber Creek, we do like to lead rounds. We like to be a true partner to founding teams. We like to take seats on the board, really, because we help our portfolio companies supercharge growth. But we've seen this before. We've done it before. We want to partner with our companies to help them do it. And so, think that while that sort of tunnel vision, tunnel focus on execution can be good at certain times or in certain periods for a company, being able to also pull back and listen to the other voices around the table is also very important, because, oftentimes there'll be sort of nuggets of important information there that might be worth sort of incorporating. So I think, right, it's execution, sort of that humility piece, being able to pull back. And then I think also, the last sort of trait I would talk about is, going back to optimization, almost the ability, and it's less the ability to, like, when I say the word pivot, I think a lot of people think, it's a 180 pivot. We're totally changing, what the trajectory of the company or the product or whatever it is. Less about that, more about the small, corner turns, right? And constantly optimizing, particularly at the early stage, where if you're going to be successful and get to from 0 to 1, which arguably is one of the hardest things to do, being able to continuously iterate and optimize, and whether that means your go-to-market strategy because you're getting feedback from design partners, or whatever it is, aspects of the product, the way you sell into the market, all of those things, right? Being able to continuously refine, I think, is very important, rather than that like tunnel vision of like, this is what I thought day one, and that can only be true, right? And that's never the case. Once you get out there and you start selling a product, you always get more information that should help inform and shape the trajectory of the company.
I love you calling that out. I mean, it's never what you imagined before. It's like it's every 6 definitely 12 months, picture will change, and you will be somewhere you didn't even expect it to be, to some extent. So these small corner readjustments or pivots. Yeah, that's definitely coming. And I love you calling out that ability to listen. I actually been part of a couple very successful startups where the founders effectively being CEOs or any CXO positions were really trusting themselves and their opinions and sort of failed to listen to the board and ended up going nowhere. It's such a hard lesson. And when you reflect back, you go like, oh, such a shame. We have been given advice, which actually now retrospectively was the right advice to go after, but we just went like, nah, we know better. A costly mistake. Right. So hype,
Well,
Alexandra.
Mike, to
Yeah.
that point,
Yep.
I think that's a great point, right? And I think you get into, right, a company goes through periods of fundraising where you're almost like selling the business, right, to investors or courting VCs. You
Mm.
go through that period of fundraising, but then once you enter the partnership, once you've got investors around the table, the dynamic should very much change, right? And I think if the pitfall is when companies stay in that sort of sales mentality to the rest of their cap table, right?
Mm.
It's not about selling at that point. We've invested in you. We are on your side. We want to support your growth, and it's how can we do that together, right? So when we or somebody else around the table is bringing an idea to a founder, I think it's generally from a place of we've got the best interest of the company in mind, and let's figure this out together, right? It's that partnership mentality.
Mm-hmm.
But
I love it.
I've seen it the other way, right? And I think it's hard to switch on and off, fundraising mode and not fundraising, right? Not fundraising mode.
Mm-hmm. I love that. Yeah. It's definitely that. If you're buying into your part, you're taking money, so you raise some capital. So hopefully you did that very well. So you're not only getting a capital injection, you're actually getting a partner, an ability to access more network, more people. There's so much more value than just the pure capital you're getting if you did your investment rounds well. You should listen. I mean, you should take any advice you can and evaluate that, of course, through the whatever is your value prism or whatever you need to make a decision about. You don't just take it as as given and you execute on that. You add your own opinions on that, but there's so much you don't know, especially if you're a young founder, right? Like there's just so much unknown that you're going to learn through failure. So you're going to make mistakes and then you're going to learn your lesson. Someone can come in and just go like, look, I've been in that room. I know what mistakes you're probably going to make. So how about this? So we're talking about that humility to listen. That's a good assessment, right? That's what we mean here.
Totally. And
Mm.
I think humility is one piece of it. I think transparency, interestingly, is another piece of it, right?
Mm.
You learn by bringing these things up, right? And so as a founder, I think the more you are transparent with your, the folks around the table, your investors, and you're really raising kind of like the meaty issues, right? And not just
Mm.
sort of skipping over them because you think you can handle them or whatever. And even if you can handle them, right, I find it's always helpful to discuss it with more people, because you end up getting to a better outcome when you're sort of bringing together the folks around the room.
100%. You're just getting more input, isn't it? More ideas, more different perspective, which you can distill to a much better decision.
Yeah.
Yeah,
And
100%. Yeah.
it's interesting, like while we're on this topic, you mentioned like you go through the fundraising motion, and then you got a partnership, right? And if you did that well, I think a big piece of that process, which I'm sure we'll talk about, is it's almost like, I mean, maybe this is the wrong analogy, but it's like dating, right?
Yeah.
It's not just one sided where you need to sell the capital on your business. It's also you should evaluate the capital and the VCs that you're talking to. Are they a fit for you in the business too going forward? And so and what
Yeah.
type of, to your point on, they bring relationships to the table. They bring, so oftentimes this with Camber Creek, we bring our network of limited partners who are potential customers and partners for the companies that we invest in. So we're actually an accelerant for growth
There you go.
directly, with our portfolio companies. And so, I think understanding the type of capital too that you're talking to and that you want for the business is really important.
Yeah. Worst situation you can be in is to take money and then end up with someone you don't really want to have in your cap table. It's such a terrible situation to be in, especially if that relationship as well becomes not a hostile, but unfriendly in a way. You just got you just shot yourself in the leg. It's going to be very hard to run. I love the analogy of dating, by the way. It's a relationship. It is a relationship. You want to be in a good relationship, supporting relationship, empowering relationship. That's a good position to be in.
And to your point, right, you obviously don't want the relationship to go south, but I think you also want to be in a relationship. I mean, everyone's different, right? Sure. Yep. But you do ultimately want to be in a relationship. That's why you're raising the capital. And so I think, it's something to think long and hard about. If you're out there for somebody to just write a check and walk away, is that really the direction that you want to go in? Because, there's so much capital. Well, I should say, there is a lot of capital out there. There is less capital that can really be a true partner to you. But I think that's where the real value is for most founders and for most startups, particularly given you're in such sort of a vulnerable phase at that early stage. Having a true partner alongside the capital is very valuable.
Increases your odds of success drastically. Yeah.
Yes.
100%. Right. So you mentioned hype, Alexandra. You said we don't chase hype, and there's a hype today, and we can come back to this. So I took a note. I want to come back to this. So what type of pitches you're seeing right now? Like, what's the hype right now?
Everyone's right. AI has been the hype for a long time. For a long time in the VC world means 24 months, right? But sure, AI, and if you want to take the new flavor of it, perhaps AI agents and application thereof, and so I think it's interesting. Camber Creek plays specifically in the prop tech space, which has as a specific market has its own set of nuances. But even more broadly than that. The number of companies that I get pitched where the front and center, AI is in the name of the company, or this is solely how they define their pitch. And really, when you dig into it, sure, like they use AI, which, by the way, AI has been around for
quite
decades,
some time. Yep.
Right. So I don't think there's a need. There's not this need for every company to solely define themselves by these buzzwords, right? And to be honest, VCs are going to see through it. Like, let's get to the crux of the problem that you're solving, and is there value there? And I think that's really the lens that I look at companies through: is, are you solving a real world problem, and is there an ROI for your customers? In adopting, the product that you're selling, and maybe that means AI is front and center, but maybe that means it's not, and I think that's okay.
From the most recent pitches you've seen and heard, Alexandra, how many of these percentage-wise had AI in it as a core of the pitch? 100% of that?
Recently, yeah, probably 90% plus, yes. And look, it's certainly warranted, right? Like I do believe, the tailwinds of AI and the application thereof in prop tech and outside. Still looking through the lens of, like, are you solving a real problem, right?
Yeah.
Because that is the baseline.
Yeah, exactly. Is the AI just in the name? Are you just putting some API calls on top of, OpenAI, or are you actually developing a unique technical solution where you're training your own LLMs, which solve a real problem? Like then it's AI tech, right? I've seen so many of just literally like just a layer on top of OpenAI, making some calls. effectively generative AI, and then huge names, we AI, this and that, and it feels like the whole market is now just that. It's just everything is just AI. It's becoming old. I don't know. Maybe it's me, but I switched from excitement to skeptical the moment I see that in the name. I'm like, oh my god, it's like, tell me something new. Is it just me, or Alexandra? You have the same feeling?
Totally agree. Like
Yeah.
we don't need more generic wrappers for ChatGPT. I think what we do need is fresh perspectives, right? People coming in
Mm,
either from inside the industry of the pain point that they're solving, or out even outside the industry of the pain point that they're solving, and doing something differently, either disrupting a workflow and
yeah.
and by the way, Mike, I think right, we're talking about AI, and to some extent, I think what we're getting at is the technical moat here, and
Hmm.
that I think technical moat is a as a concept or a term has changed like quite significantly, over the last 24, 36 months. Um, I think there are other interesting moats to be had on top of that. But I think being really clear about that is important for founding teams, particularly given it is much easier to build product today. And to your point around, are you just another wrapper for a public
Hmm.
facing LLM? Is there another moat to be had, or is there not? And I think that's from the VC perspective. That's something that we're thinking about. And is important. And I think there are also other interesting and important ways that companies can be using AI, not just in the product they're selling, but also internally. And so, I think that's another thing we look for as a VC and at Camber Creek is the founding team, like, a lot of people talk about AI native, right? And that doesn't just mean the product you're selling. I think it also means the mentality of the founding team, and are you able to do more with less is basically the crux of it, right? And Mike, I know you've got a technical background, right? Like, so you could probably talk way more in depth about this, but can your technical team be 1/10 the size of what it historically maybe would have been, things like
100%.
that.
I can add some context to this. So we just had an episode last week with the PayPal head of innovation, and he defined it that this is an age of solopreneur, and effectively the idea of the whole episode and the topic we were discussing is a one person right now can do so much more because of the AI enablement. So you can do marketing so much quicker, your messaging, the websites, you can code so much quicker, you can prototype solutions. Effectively alone, you can cover foundation team and you can spin up ideas very, very fast, which means there's likely going to be, a lot more solopreneurish type of ventures coming out, which leads to that, notion of AI native as a team. You likely want to have founding team who thinks like that. Like, why would you, hire someone who can code well versus someone who can orchestrate AI agents well? It's
Exactly.
I feel like we're moving into that, agentic, and that's a term, by the way, if you put in the Google, agentic automation, where effectively it's not just generative AI, it's not a single agent, but you have a full workflows, and in the middle you have multiple agents which take a role, such as marketing or sales, and they automate the whole shebang for you effectively, the whole workflow, and they make decisions for you as well. So it's just not an input and output, but the AI agent actually is capable to make some calls for you. It's very exciting times, to be honest, where we're moving. I'm drifting. You pulled me on the right string. I could talk about this for hours. All right, let's go back on a pitch. So one thing which I wanted to uh, understand, if how important to you is these intangibles, as I call it, like confidence, delivery of a pitch, a story behind the product. Like, are these things that have weight in the sense of success, or is it still like, look, we're gonna go through the crux, we're gonna look at problem, solution fits, and everything, and that is just sort of not that important?
I think it's a great question. I think the pitch is certainly important, but maybe not for the reasons that you're thinking it is, right? It's for me, the pitch is important is because we want to understand how founders are selling their company essentially, right? And so if I'm sitting there, if you can't sell to an investor, then are you going to be able to sell to a customer? And so
Right.
that's the
Okay.
lens that I'm having, right?
Right.
And
Okay.
you've got to have deep belief and conviction around the pain point that you're solving to go into any customer, particularly, I mean, if you're a B2B enterprise SaaS company, to go
Mhm.
into a large enterprise and say, hey, we're going to disrupt, we're a new company, we have a new product, and we're going to disrupt a workflow or something else, right?
Mhm.
And that takes a very certain type of articulation and sale. And so that's a big thing that we're evaluating, right? Is the management team or the founders, do they have conviction around, the product in the
Yeah.
market that they're selling into, so that, I think that's a big piece of the pitch and the way we think about the pitch. Does it matter, the pictures that you throw on the different slides? Probably not.
Mhm.
I want to get to talking about, what does the traction look like? That is, really important.
Mhm.
And by the way, it almost doesn't matter what the answer is. There just needs to be a well articulated answer as to, right, because every company is going to be at a different stage.
Yep.
But where being able to explain where you are today, and then where you're going to get to in the next, call it 12 months with the capital you're raising, and have that be realistic, right? I think the realistic piece is the other piece, like that particularly, for us at Camber Creek, that
Mhm.
we're vetting. If you tell me you're going to go raise $1 million to get to $100 million in revenue
Yeah.
in a small market, right? I'm sort of like, that's a little bit of a question mark. I'm not really sure. I'm not saying it's impossible, but it's certainly like throwing up a yellow flag. And so I
Yep.
think, being realistic about, the projections that you're putting forward, right? You can make any chart that has sort of that exponential growth curve, but it's the devil's in the details, right? And we're paying attention to that.
Yep. I love that. I've seen these head in the cloud, vision and pitches as well. It's always like I get this like, do you even believe? Like, are you saying this because you really believe that, or are you saying this because you think you'll convince me about some moonshot type of investment? I always get this like, I'm trying to understand if it's just the words you're saying, or you actually have a buy-in yourself, and then you start asking these grilling questions, and you take them into details of how you come up with the numbers, why you believe that's the number, what's your addressable market, and all that stuff, and everybody cracks eventually. Like every time you see this exponential curve, once you ask the questions, there's cracks. People are unable to defend that. So most realistic one is, which is actually just a realistic one. So the story matters. We said that. I really love you calling the confidence or the ability to sell, because effectively what we're saying is that you're pitching to me. If I believe you and you're able to sell, your vision, your product to me, I'm quite confident you're going to be able to sell that to the market, isn't it? That's what we're looking in that delivery.
100%. It's almost like
Yeah.
the sniff test, right?
Okay.
And I think that comes back to, Mike, your earlier comment of the sort of pie in the sky idea, right? Like, sure, it's fine to have like a really lofty idea or a lofty goal,
Mm,
but we want to very quickly get into like the meat of what's going to happen over the next, particularly at the early stages, over the next 60, 90, 180 days, right?
yeah.
And what that really looks like. And so, um, I would say, um, the 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 as we're talking about, components of the pitch, right?
Mm,
Um, getting into the details of for, as you, Mike, as you mentioned, right, the TAM, right, being realistic about the size of the market and the specifics of the market, right? I want to know that you are intimately getting to know the market that you're selling to, not just, hey, this is a multi-billion-dollar market because, ChatGPT told me it is, right? I want to understand the customer nuance. And I think that also leads into, even if you're at that, sort of stage zero with your company, having put some thought into things like go to market are really important. And I think having, again, going back to like the humility piece for founders,
Yep.
it's okay to say, this is the way I'm thinking about the go to market approach. We will continue to refine it, or, we haven't, it's not nailed down in full. This is the way I'm thinking about approaching it based on, XYZ number of factors. And I think that opens up a great and really productive conversation too, for in this sort of like dating game, right? Where you can then get really helpful feedback from the VCs that you're talking to, even before they invest. And I think that's an interesting opportunity for founders to get some feedback on their product, right? Because we're talking about a lot of this is, or I think a lot of the way, startups approach fundraising is, it's sort of like this sigh, right? It's like, I've now got to spend all this time fundraising. But I think the reality of it is you can gain a lot out of the process if you do it in the right way. And so you can get a lot of this feedback as you go from VCs, from, by the way, folks who have seen businesses, have built businesses, have exited businesses successfully, and get that feedback. Even if they don't ultimately invest, I think there's a way to have those conversations that are productive for both sides, and end up by hopefully leaving the founders, right? Our goal at Camber Creek is, in the diligence process, we actually do things that are additive to the founders that we're talking to. And so it ends up being a much more collaborative process.
I love that. Ultimately, what you get, even if you don't get the funding, is you get good questions being asked, and potentially you don't even have the answers for, so you can go do some homework and just do better for the next pitch, or find your new partners and actually get into crooks into good questions and understand how everything will happen. I love you mentioning go-to-market as well, Alexandra. I want to pick on that, and TAM as well. So you mentioned these like being important ones, the total addressable market and go-to-market strategy. What do you like when you ask these questions, what do you like to hear? Like, how do you evaluate if that's a good answer or not?
Is it realistic? Is the lens that I'm looking through.
Is it realistic? Okay.
So,
Yep.
right. And maybe I'll give an example, right? So I'll give an example from prop tech, because that's our bread and butter. If you say you're going to sell to real estate organizations, well, there are thousands upon thousands of real estate organizations. What is, $40 trillion worth of value in the real estate markets? What is the subset of the customers that you're going after, and what is the persona of the customers going after? For example, are you selling to the owner of the building? Are you selling to the property manager, so the person physically on the ground, on site at the building that's doing a lot of the on-site work? Are you selling through the building to get to the tenant or the resident? Are you selling to the broker or the person handling the transaction of the sale of the building, right? So there's so many different components, and this is the case really for for every industry, right? There are so many different components and nuances. And it's one thing to say the $40 trillion real estate market, and that's your TAM. It's another, to be frank, I would just write that off, right? It's much more productive to say, okay, here's the first iteration of the product, and here's the subset of personas that I'm selling to, and this is the size of that market. That to me is what I look for, what I want to see, and have a and I think there are ways to have a productive conversation around that too.
So if someone goes and you ask about ICPs and so ideal customer profile, and someone goes like, you know what, we can sell for everybody. Like that's one answer. And then second answer is I'm selling to landlords who own from 3 to 5 real estates, total value of portfolio 25 millions, and that's their problems, and that's how I'm going to solve that, and that's how much of addressable market I have. When you compare those two answers, if the first one goes like, well, the product is so unique, we can sell to everyone because it's AI enabled, that's not a good answer, right?
Right. Yeah, immediate yellow flag.
Yellow flag, not a red flag. So you would still dig into it, right? You would go like,
I mean,
well,
listen, I always like to think that like we stay open minded as VCs, right? And at Camber
okay.
Creek, we're always open minded, but yes, yellow flag, 100%.
Yellow flag. It could be just maybe inexperienced founder, right? Who maybe didn't do the homework, but they still have something. So you want to dig deeper, but ultimately, it doesn't really show that you did the homework, isn't it?
No, and if you don't have more substance to back up that answer, then the yellow does convert to a red flag.
And then you get thank you. We'll be in touch.
Yes.
Right.
Well, and I think, Mike, to that point, right, on the thank you, we'll be in touch. I think the most direct, and if I'm biased because I think we do a good job of this at Camber Creek, is we'll tell you directly what the feedback is. It's we're fairly direct as to why we're not investing, and I would say in that case, I think you need to refine your thinking on the addressable market.
Mm-hmm. And here's your feedback, which is again a lesson learned, isn't it? Someone can go home and really think about that, right? So I want to touch a little bit of chemistry around founders and see what you think about that. I personally was in a couple of startups where the chemistry sort of is good between the founders, and when I say founders, I mean they have shares in the business, so they're part of the cap table. But then eventually, business grow and the challenges grow, and the weight of decisions grow as well. And one wants to be a CEO, and another wants to be CEO as well. And suddenly there's clashes. So it's my business, it's your business, and it just sort of explodes into like a real problem. So in the beginning, when you think about investing, do you look at who the founders are, what are the backstories, how they met each other? Is there chemistry to sort of predict potential future problems?
100%. I mean, founder to founder relationships are one of the number one reasons why down the road companies run into issues, to your point. And so it's not just how did you meet your co-founder? It is, have you sat down and had some of those difficult, pointed conversations with your co-founders? Everything from what are your finances like? How do you think about spending money on a personal level? What are your upcoming expenses on a personal, right? Getting into that personal, because when you go into starting a business, it becomes personal. It is your life. And so, I think there is this, sometimes this, sort of lean to try and separate, work and personal, right? I think that's natural, right? But when you're starting a company and you're going into business with somebody else, I think it's very important to have some of those deeper personal conversations so that you really understand where the other person is coming from, what their constraints may be, how they approach working, right? Working styles, I think, is very, very important too. And all of those components. And so we're not just evaluating, each founder, co-founder individually or in their own silo. It is very much, what is the relationship? And, I think also how they interact and how they complement each other is really important. So, I think an important thing is when if you're going out and looking for a co-founder, for example, what are the personality traits or working style complements to you, and so that no one person is going to be perfect, but if you've got two co-founders coming together, I think you can often have it can work in the, we talked about what happens if things go awry. It can also work to the benefit of the company too. You've got two complementary personalities. Sure, sometimes that creates a little bit of healthy friction. I think also the another important distinction is friction that detracts from the company, and then healthy friction, right? And I think that healthy friction is actually quite productive, is a nice check and balance at times, and so I think being very intentional about that too as you're building a founding team is important.
Is that later down the process, or is it part of the pitch? So I'm just thinking from a perspective of a founder, I'm gonna have a slide about the team. I mean, everybody has a slide about the team, so probably I will show the team, I'll show the founders. Do I care, to say that during the pitch, in the sense like, hey, we've been best friends for 12 years, and we did some other businesses, so we tested by trial and error or something like that. Like, is that an important message to put in a pitch, or is it like really doesn't matter that much, and you will figure those details later in the stages?
I think if there's a positive story to share, it's to your benefit to put it in the pitch, right? And to mention it, right? So if you had another successful company with your co-founder, and now you're going at it again a second time, that's fantastic data to be able to share with investors, right, or prospective investors, because that, to me, that says you've weathered that potentially strenuous relationship over the life cycle of a company, and by the way, now you want to do it again, right? So I think that speaks volumes. Not every situation is going to be like that, but there's I think a little bit of flavor, context for the relationship is always helpful, and then digging into it more, and then we'll always dig into it more throughout the process down the road.
What if I'm just random, I just got my co-founder like 6 months ago because I put a job listing on LinkedIn, and we just came together and we just built this tool. Is that like a yellow to reddish flag instantly, or you give a chance if the, let's say, idea is great?
I have encountered situations like that. It's not a red flag, but certainly something that I will spend more time on as a potential investor. And so I would look to understand why individually are you both trying to solve the same problem? What is resonating with each person? And I'll spend more time probably together with the two founders to really, get a feel for their dynamic, get to know them personally, get to know, their style. And so, yeah.
So for you,
it's not a red flag, not a red flag in my book, but certainly something I would, think harder about.
It elevates risk profile for you, isn't it? Which you need to effectively assess risk around that.
Certainly. And to be honest, right, with any, even with any first time founder, right, there's a little bit of an elevated risk there because, they have not built a business before, and you need a, very certain type of, person to say, hey, I'm going to come in and disrupt, something in the marketplace, and execute on it well with limited amount of capital, right? And so, I think, it just, we would not be anywhere without first time founders. So we need them, we encourage them, but certainly, vetting the a lot of the things, Mike, that we talked about earlier, about personality traits and things like that are very important.
Okay. So I want to read this quote from TechCrunch. Early stage investors consistently point to traction, not vision or product, as the top reason they say yes or no to a startup. And you did mention traction. So let's imagine this now. How small is a traction that can still be considered a traction?
A good question. Well, look, certainly pre-revenue, I think, can be considered traction if you've got, I think it's one thing. So I'll give an example. If you've got you've got two companies, they both have MVPs that are up and running, are
Yep.
usable.
Hmm.
But you've got one of them that is put it in the hands of three to four potential customers,
Yep.
and you're getting, real-time feedback from those pilots, versus one that just has this MVP, hasn't gotten any feedback yet. I think that to me is very different, right? And I think the to me, the company, right, the company that has those pilots underway, that is actually testing it and trialing it with potential users,
Hmm.
is further along in the process from the traction standpoint. Neither company, by the way, has any revenue, so
Okay. So it's possible then, it's pre-revenue effectively traction, right? So we're saying if you have a product which is getting tested, and in B2B market, I guess a 3 to 4 companies testing your product is a good number. Can you still raise money on that? Like, is that still, let's say, because you're getting
are
a
you
lot.
going to get paid for it? Is the right? Is
Yeah, yeah. So
is the
I'm just,
valuation going to reflect that?
yeah,
I
yeah,
think is the
yeah.
yeah. That's a good question. Look, um, I think the question is I think the answer is it depends. Um, Typically, no, though, right? At that stage, you are, typically still considered, pre-seed, a seed stage company with no revenue, right? And
Yeah.
that, the valuation band on that is, within a very specific range. Um, and so, it certainly does help. I think it also helps as you're, talking to VCs, even land a lead VC, right? And so there are other perhaps intangibles that it certainly helps with, apart
Mhm.
from valuation. Um, uh,
Do you
so
even want to raise, Alexandra? So sorry to jump in, but do you even want to try to do this? It's like, if you're testing, you pre-revenue, should you just maybe wait until you're actually getting some revenue and then do the raise? So I see people going after the raise before they get any revenue, and that was very, very popular. Like 3 years ago, when there was abundance of capital, and everyone was giving money right and left. And I've been part of so many pitches where it's like, look, it's just an idea you're pitching. Like, you don't you don't even have a product. Like that's where the market was. So from your perspective, is like, is there like a sweet spot where you go like, look, this is how much money we're making, this is the right time, like that's the best time to raise right now, we're in a good spot, we're making enough, we're going to get a good exchange of equity to raise capital, like where is the best spot over here?
to a large extent, I think that's sort of the $1 million question, right? And
Yeah.
and to me, I'll tell founders this directly. If
Mm.
you don't, if you can execute on, the next, on your plan over the next 6 months without capital, there may not be a need to raise, to your point, right? Like
Hmm.
you should not just raise for the sake of raising. And
Raising.
and I go back to the trade-off conversation that we were having, which is everything's always a trade-off in the
Yeah.
early stages of a startup. And so if you feel like additional capital can come in and make a meaningful difference in terms of accelerating the business forward,
Hmm.
and again, it's also capital and partnership, right?
Yeah.
Not just the dollars in, but also the partner that you're bringing to the table. If you feel like that relationship can meaningfully accelerate your growth, then yes, then I do think there is, I think there is I think it's important to go out and really think hard about, do you raise now or later? And the answer may be now, if the answer is yes, right? But to your question around, should you wait until you've got, some amount of revenue coming in the door? Yes, I think it always helps the story and the conversation to say, hey, I've got customers actually paying for the platform. So
Hmm.
so yes, but not necessarily a full I would say a requirement, particularly in the B2B enterprise world.
Okay. Do you ask a question during the pitches like, why are you raising money right now?
God, yes. Yes, uh, usually like the third or fourth question that we will ask, and it's funny, the answers to that I've gotten range quite a bit.
Yeah.
I think it's important to have a very have thought out that answer. And to my earlier comment, I don't want to say that there's a right and a wrong answer, but there is a right and a wrong answer. And to me, it's really about the accelerant piece. And, is now the time where you feel like capital can truly be, are you maximizing the acceleration of the capital coming in?
Yeah. So effectively you're saying, I'll give you £1. How confident are you? And are you able to defend the fact you're going to give me £4 back? That's
Yes.
pretty much that was what we're asking. And you said this is your fourth question, plus minus. What are your first three questions?
Good question. One is I start with why. Why are you solving this
Behind the
problem?
product? Yeah. Okay. Yeah.
And a little bit about the product, but more around the pain point that the company's trying to solve. Why have you identified this as a pain point, or what is the pain point, right? Why have you identified this as a pain point, and why are you trying to solve it?
Okay.
And then I would say my second question is, how much efficiency do you think can be realized here by a customer down the road? And so that I'm sort of getting at with that one is, how much better is what you are building versus the status quo? And to me, especially in the world, I think for everyone, right? For a consumer, for an enterprise, you're not going to change a workflow. You're not going to change a habit if the alternative is, 1 to 2 times better than what you're doing today, right?
Mm-hmm.
It's gotta be 5 to 10 times better to warrant that habit switch. And so if I'm, and we've seen this numerous times, right? And talking about in B2B enterprise SaaS and in the prop tech space inclusive, almost the pain, right? An organization has to go through of introducing a new software or introducing a new workflow or changing a workflow and training and getting the team onboarded and fluent with that, right? The product has to be a number of times better than what's in place.
I do agree. Very strongly agree. I work for enterprises, and tool change is such a pain. Like, people think 7 times before they actually pull the plug. I mean, I'll be honest, cost is probably the number one at enterprises for the change. It wouldn't be, you always look at the future parity, of course, but with enterprises, because you have thousands of people, eventually, you reach a level where you go like, okay, well, the licenses we're being offered is just way too expensive. So then you look for alternative. But when that takes place, the change of the tool is just so much pain for everybody. Rolling out, change management, no one's happy, everyone's annoyed for at least the next 6 months. So in B2B enterprise world, your tool has to bring something very, very worthy of that change to take place.
Yeah, and unfortunately, the change management piece is it's just human nature, right? And so I know that's never going to go away. And so, so that's a very important piece that we spend time on. And then the third question, I ask about traction. And I think with those 3 questions, I can oftentimes myself, well, I don't want to, I can oftentimes answer the 4th question without hearing it from the founder, but I do ask it. And that helps sort of, I think the understanding the answers to the first 3 questions really help VCs, understand that, why are you raising capital question, right?
I love that. All right. So let's talk about the importance of thinking about the exit or how they will return capital to you. So I have this quote from Crunchbase News, which goes, founders who can speak clearly about exit strategies early on tend to inspire more confidence because VCs must plan liquidity events before they invest. Is that true?
It is true that VCs need liquidity events. Yes, that is true.
Do you think about this from the get-go's? Like when people
Yeah.
pitch, do you actually like the fact that they go like, look, I'll take your money and in, 3, 5 years, I'll give you 6 times, back. And then this is how I'm going to do that. Is that important?
Yes, look, I think the exit is always important and is something that we as a VC are thinking about even before initial investment.
Yeah.
However, to your question on do I want to hear a founder, how do I want to hear a founder
Hmm.
talk about it in that initial pitch? And I think there is a right way and a wrong way. And this more goes back and speaks to the personality of the founder and also the thoughtfulness of the pitch and what they've put into the company to date, right? And so
Hmm.
if I hear a founder that says, 100% we are going to IPO in 5 years, I mean, we're talking about going back to yellow and red flags. That is
Yeah.
a red flag.
Yeah. That's
Hands
a
down.
red.
That's
It's not even yellow. That's
that
a,
is a red
yeah.
flag. So,
Thank you. We'll be in touch. All right. Why is it a red flag? Because it's just not realistic to IPO in 5 years, isn't it? From early investment, is that why it's a red flag? It's just like you're not being like you're so outside of the realm of reality that I doubt you even know what you're talking about. Is that pretty much what's happening?
yes. Yes.
Mhm.
And, it's one thing to convey conviction about what you're building, but there are a lot of other ways to do that. And to say with certainty that you're going to do something that, 99% of startups don't ever achieve is, I think that's just over the top
Over the top.
with hubris, right? And so, I think, also, I think being realistic about, what are you building? What is the pain point you're solving? What type of company, um, and what is, the long-term margin profile of the business? That's how I would articulate it. Right. And
Okay.
that, I think, talking about it in that way then allows the VC to refine their view on the exit alternatives, right? Without the founder
Mhm.
saying, we are, 100% going to go public, or, we are 100% going to sell to this strategic, right?
Okay.
To me, it's more about, what are you working towards and how does that translate into the key metrics of the business longer term?
So effectively, we're saying it's not needed to talk about the exit in a pitch and show that we're thinking about it. We're saying that show enough understanding around how you're going to utilize the raised capital to just grow, and we will infer the exit ourselves? Or is it actually healthy to say, like, look, we are thinking about the exit in 5 years? Like, which option is better?
To me, it doesn't matter.
It doesn't
I
matter.
think, I think it is it's a little bit like gambling when I hear, we're going to exit in 5 years. You put
Yeah.
some sort of
Yeah,
predetermined,
that's true.
right? Like time, right? First of all,
Yeah,
5 years is a really long time.
exactly.
You don't have any revenue right now, so I don't know what's going to happen in 5 years, but you also don't know what's going to happen in 5 years. So,
Okay. Yep.
it's sort of just a waste of time, I think, to spend to talk about it in that sort of certain way.
Mm.
Again, to me, that's why I go back to, let's talk about how you're thinking about building the business long term. What is the
Mm.
vision long term? And this is getting into, what type of company are you, right? Are you, pure B2B enterprise SaaS, or is there a services component? Is there a hardware component?
Mhm.
Is there a B2C component, right? And how does this long term translate into the sort of the margin profiles of the business? That is a much
Yeah.
more
Yeah.
productive conversation than saying, we're going to exit in 5 years, and
Yeah.
then the VC on the other side of the table has no idea what to do with that,
Yeah.
and frankly is going to just tune you out.
Yeah. Well, I've wrote this AI agent whose predictive analytics is out of this world, so I'm predicting my 5-year exit. Is that a yellow flag right there? Yellow
Well,
or red?
if AI said it, then
It has to be true, right? All right. That was awesome, Alexandra. So let's go into rapid questions. We have the segment just before the end of the show, just like quick answers and hopefully, pick your brains and give some value to our listeners. So the very first one is, how can pre-revenue startup show traction?
Pilots, talking to prospective customers, customer interviews, prospective customer interviews.
User base, maybe getting some newsletter subscriptions or some trial accounts or something like that?
Yes.
Yep, pre-revenue. All right. What's the best way to demonstrate product market fit signs to investors?
Great question. Again, I go back to number one, right? If you've got some of those components on number one, you are starting to get actual market level feedback on the product, and that's the best way, to get a feel for product market fit is direct feedback from the market.
Ultimately, how is the market fit? Let me rephrase it. Not how, but when can you say that you have market fit, product market fit?
Oh, I think that answer depends, and it's not a binary. If I have revenue, then I have product market fit, because frankly, I know companies that have some revenue, and I don't think they have quite yet found product market fit. Okay. So, to me, it often comes down the road, again, depending on the pain point that you're solving and the product. But just because you have revenue, I would not assume that you have a market. That means you have it, right? Especially at the early stages. Okay.
What are the common mistakes in a pitch deck for investors? So we talked about everything what should be there. What are the red flags you see where, people come in and do the pitch, and before they even finish, you go like, nah.
So this might be an unpopular opinion, but I do not want to spend time watching a video demo of the product.
Okay. You don't want to watch.
I
see what I mean. So in the middle of the pitch, they go like, in this slide, we're going to show you a video, and they click play.
Yes. Happens quite often, frankly. Right. And, I'm in the meeting because I want to be talking to the founder. I want to be talking to the team. I don't want to watch a video. I can do that on my own time.
Yeah. It's such a no-brainer that it's very surprising you still see that, which probably leads to this realization that lots of founders don't know what they don't know. The pitching is new process to them, and they're gonna effectively make mistakes, right? Should we allow them to make that mistake and go like, okay, fine, I'll watch your video. Let's just continue with the pitch. Or, from your perspective, Alexandra, you just go like, oh my God, nope, red flag, bye-bye.
No, Mike, listen, I'd never, and we talked about a lot of red flag things today. Even with anyone in isolation, I never am going to write somebody off because of that, right? Because to your point, everybody is coming in. I think that's one of the best and most exciting things about startups, the startup community and world that we work in and in venture capital is you've got people coming from all walks of life, all different backgrounds, and that's the opportunity. And so no, I'm never going to write somebody off for one of these single, perhaps if you want to call them missteps. But hopefully in talking through this, we're sharing some things that then founders hear and can apply going forward.
Do you watch the video until the end, or do you go like, hey guys, can we just skip over that slide and just move on? What's your answer? When they launch the video, you're like, how many minutes? Is that 7 minutes? Oh my God. Can we just move on? Do you shut down that slide like that, or do you patiently watch the video and take notes?
Oftentimes I will say, hey guys, can we talk through the product, or can we move on to the next slide? And I'll say, hey, I want to be talking to you. I'll watch the video after. And then by the way, I do watch the video after, but I do it and it's more productive for everybody, I think.
Yeah, I do the same. I'm like, just send me the bundle, if I'm interested, I'll take a peek. Right. So what do VCs look for in the due diligence process? So the number 1, 2, 3, the top three is when you're starting the due diligence, what are the main things?
Great question. We're looking to vet traction, so go deeper in traction, more deeply understand, things like a company's pipeline, their
Hmm.
approach to go to market, and the team. I would say the team is very important, and so we're not just, depending on the size and stage of the company, we're not just looking at the founder or the two co-founders, whatever it is, right? We're looking at soup to nuts, the entire team. What's the structure? Does it make sense? What is everybody's role? How efficient is the company? And so we're digging into those components in addition to, if again, it depends on the stage of the company, right? If you're a more mature company, you've got a year and a half worth of P&L. We'll spend time on components of that and some of the KPIs and key metrics. But at the early stages, I would say it's those handful of things.
Okay, excellent. How should a startup present its go-to-market strategy in a pitch that it actually lands well?
The go-to-market, good question. So, I think it can be, woven into the TAM conversation, right?
Hmm.
And as you're talking about TAM, ICP, and then what does that go-to-market look like, and why for this ICP? I think that's a really sort of natural, evolution of the conversation. And I
What are,
think
yep.
go ahead.
What are the components of go-to-market you care about? Like, marketing, buying ads, or like any components you go like, that's a good go-to-market strategy.
Yeah, how you're doing it, and the cost, the team it is required to do it, and why you think it will be effective. So I
Okay.
think those come out right. So if
Excellent.
if I've got a company that says, we're gonna, our go to market is, we're gonna buy a bunch of Facebook ads, and we need a team of 3 people to do that, and $5 million a year to do that, versus a company that says, I've got a team of 2 sales leaders that have relationships in this industry, and we're going to go sell this B2B enterprise product. Different approaches, different companies,
Mhm.
something to to talk about and evaluate. But I think the perceived efficiency around go to market is very important.
That's an excellent answer. What are the effective ways to create social proof for startups?
Great question. If I'm understanding correctly, around sort of
Yeah,
you're saying social good.
recommendations. Yeah. No, it's just like, yeah, we got some people telling us how great our product is,
More
or
like, yeah, I think organically is the best way. If you've got an early trial, user or a customer, and they've helped you, they've given you advice about the product, from the outset. I think building those relationships early on is very important, and
Mhm,
then being
mhm.
able to, oftentimes you can go to them and say, can you be a reference for, can you be a customer reference for me? Can I share a quote on my website
Yeah.
from you, right? So I think if you can develop those relationships in the right way, then that social proof thing, I think, comes more organically.
Is that a good proxy for the traction as well? Just getting those social proofs.
I think it can come in a lot of different ways. At the early stages, having a, 1 or 2 people as design partners, or, bringing them into the fold to say, we're going to give you access to this product, maybe even for free, but in
Mhm.
exchange, we would love your feedback. Give us your feedback, right?
There
And
you go.
having a way to make it somewhat give take, and as a good way to develop some of those relationships.
I love that. How does a founder's story influence investor decisions? So let's say I'm alone. Maybe it's a couple of us, but there's a very clear story why we're building what we're building versus we see a niche in the product, and we very in the market, and we are very business orientated, so we think we can capture stuff. Like, does it matter why we're building this, the story behind this?
Not necessarily between those two examples, but
Okay.
uh, this, but I don't want to say the story doesn't matter, right? Because it does. It does. I think you can approach it in different ways. And I think always want to know the truth, right? I don't want a contrived story. But I think there are multiple ways to recognize there's a problem and try and go after it. And so understanding how you've done that is important. And there's no sort of one story that will only resonate with VCs.
Okay, I love that. So we talked about traction quite a lot, and a lot of proxy numbers was given. I'm very interested to know which is the most important, but not the revenue.
In terms of metrics.
Yeah, like traction metrics. You can't choose revenue. What's
Burn.
the second most important?
Cash burn.
Cash burn. Why is that?
Even if you have no revenue, presumably you are spending money. And I want to know how much you're spending and what you're spending it on.
Yeah. So if I'm giving you $1 million, I just want to understand how quickly you're going to spend it and why and where, right?
Well, I want to know, how efficient you are and how efficient you can be with the capital that will be investing in you.
So you just want to know if they buying croissants for the team in the breakfast.
Exactly.
Such a cliche. Right. So how should startups frame their total addressable market to appeal to VCs?
I think we talked about being realistic about it. Maybe that's, this is a non-technical answer, right? But I think being realistic and also being focused, I think is a good sort of framing for it, right? Being focused in terms of your addressable market and what that means. So, I think to some extent the detail matters.
So we touched on being over optimistic to the point where it's just not realistic, being a red to yellow flag. Can you be the same on an opposite side? Can you be so pessimistic that you're not giving yourself a good chance and you're not presenting a real potential and a real opportunity in your pitch?
Yes, you can always be too detailed, particularly in an introductory pitch. I think there is certainly a balance, right? Because and I think it's important to understand. Take 3 minutes before the meeting, and I tell all the founders that I work with to do this. I recommend it is understand who you're talking to, what is their background, how much do they already know about the market, and so if you got us at Camber Creek, we're prop tech focused. So all my bread and butter is real estate technology. I know the real estate space intimately inside and out, and we do as a firm, and so I don't need 30 minutes spent on understanding the nuances of the real estate market. I think it's, give me an understanding for, your ICP, what you think, what segment of the market you are going after, and then let's move on. And so, I recommend that for, across any industry, any founder that's talking to an investor or potential investor, understand that investor's background. How much context do they have for your business, your market segment, your industry, and I think tailor the conversation slightly to that, right? So if you've got somebody that might not have a lot of context, sure, spend an extra minute or two going into a little bit of the nuance of the market. But if you've got somebody, right, you're talking to somebody that knows the market intimately, has maybe invested in 3 other companies in a similar or adjacent space, I would frame that conversation differently, and I would spend time on less of the framing, right, on the market side.
That's a brilliant advice. Right. So if you can disclose, what was the latest investment you guys did and why?
Yes. We recently invested in a company called Twin Knowledge. The company is in the construction tech space. They allow large AEC firms, so architecture, engineering, and construction firms, to do everything from what great example is versioning of construction documents, looking across, multitudes, so hundreds of pages of construction documents on a project, and making sure that they comply to corporate level policies and procedures as a great example. So something that, typically a construction firm would have, 2 to 3 physical people doing manually checking construction documents. What Twin Knowledge is able to do is automate that to close to 100% accuracy.
Automation tool. Okay. What was there, just a good business profile, or was there some like big thing why you invested? AI?
It does involve AI, yes. Mike, the founder built and sold his last business to Autodesk, a large construction software company.
Okay, I know.
Second time founder, has experienced relationships in the space, and we believe in him.
Just strong profile, yeah. Founders get backed, especially the ones which had good success. It's almost like, I don't care what you're doing, here's money because I know you're going to be successful. I heard that story. I think it was Robert Kiyosaki, the guy who wrote the Rich Dad Poor Dad book. I think that's one of his rules, where he has a network of founders, entrepreneurs, and he doesn't really care what they're building. They just come to him and go like, I'm building something new. And he's like, I know you built already a couple of things and you were successful. Also, here's money, go build it. Right. So that was excellent, Alexandra. And so people listening, they go like, look, I want to just come in and try to pitch for you because I'm in the prop tech, or potentially some other questions. So how can they find you? What's the best way to reach out?
Email me. I always respond, an@cambercreek.com. Even if it's not a fit, you will hear back from me. We always love to talk to founders who are in the prop tech space.
Can people find you like on LinkedIn or through the website? Because I'm very cautious about adding your email in the show notes. You're gonna get spam.
Yes, connect with me on LinkedIn, Alexandra Nicoletti, and you can see my profile and background on our website, cambercreek.com.
There you go. We'll put your LinkedIn in. I think it's going to be more safer. Now with AI, Alexandra, now with AI, I'm quite sure the spammers will take the transcript of the show and they will just shove it in LLM and they will go like, did emails got mentioned in this? I'm just thinking about this and realizing that.
Probably. I actually hadn't even thought about that, but you're right. Yeah.
That would be quite easy. I'll do this test myself. I'll just take a transcript, put it in ChatGPT, and I'll see if it's going to pick on your email. Right. So that was excellent. Thank you for joining us today. For all the listeners, if you're raising money right now, or potentially thinking about raising, especially in the prop tech, I do encourage to reach out to Alexandra, see if you can find a time to pitch your product. For the ones which are thinking about non-prop tech, but still about investment, share the episode with your network. I think there's an ample amount of great tips from Alexandra in this episode, which will help you to make your pitch better and hopefully perform better and hopefully raise that capital. Good luck to everyone. And as always, until the next time, stay safe and see you online.